Pramod Gubbi joining in this morning on Talking Point. He's co-founder Marcellus Investment Managers. Pramod, hi, great as always to chat with you. And, you know, I'm going to start specifically with the point of the budget, since that is top of mind right now. Usually, I'm guessing you would have said non-event. And that's you know, what we hear, budget is non-event. Does it change in that sense, where the street is really waiting to hear what is said with the kind of mood right now?
Well, morning. It's always a pleasure to be here. Yeah, I mean, it remains a non-event, but having said that, I think from a fairly sanguine macro situation, we are moving to a little bit of a tricky macro situation over the past 3-4 months. We were going through sort of a cyclical slowdown, particularly driven by consumption slowdown. It was cyclical in some ways. We had the post-COVID frenzy in terms of spending, some of which was borrowed spending. But given that a lot of automation and AI has meant that growth has come without commensurate job creation, you had the consumer showing that weakness. To that extent, I guess the budget has its task cut out in terms of boosting consumption in the near term. But this has also meant that the government will have the difficult job of figuring out how do you balance the two objectives of continuing to go on the consolidation path as far as the fiscal is concerned. Remember, the government had to spend its way out during COVID. So we're still way above the comfortable mark on the fiscal deficit front. So you are on the trajectory to cut fiscal, but at the same time, you have to boost consumption. So I won't envy the government's position there. But what that's done to the economy is quite difficult now, given that the public capex has also been reduced again due to fiscal reasons. What's happened in the last 4-5 months in the global macro is, given the Trump election victory, inflationary expectations have gone up, bond yields have gone up, the dollar strengthened, and that's had a massive impact in terms of FI outflows for us. India is a structurally current account deficit economy. To that extent, the capital account has saved us over the years. Given this sell-off in FIs, plus the FDI weakness we've seen the balance of payment turning extremely negative. We haven't seen this for a while now. I think the last we saw was during the taper tantrums of 2013. So if you are consolidating fiscally, you need the RBI to do the heavy lifting in terms of monetary easing, but that's also tricky given where the rupee is headed. So I guess it is a very difficult situation from the policy making front, whether it's fiscal at the budget or the monetary situation at the RBI.
Tricky situation. So then let me squeeze this down to what the strategy should be. And Pramod, a lot of viewers love these conversations of ours to get a sense of what to do and what the best minds are thinking about. How are you seeing it right now? Are these, like in the past, opportunities to come in and shore your portfolio? Or would you say right now, stay away? And what are you making of the kind of slew of, I would say, very disappointing corporate numbers?
Yeah, I mean, look, from a retail investor perspective, we've always recommended people should stick to their asset allocation, have a disciplined approach to allocating between equities and fixed income with consistent and systematic rebalancing with time. There's no point in trying to time the markets. Having been in the markets for a couple of decades, I can tell you it's nobody's cup of tea, really. To that extent, be disciplined about asset allocation. From a positioning of your equity portfolio perspective, I think you will get great opportunities to buy into some great franchises in this downturn. Even some great franchises will report very weak numbers in terms of earnings. The market has been extremely punitive for even small misses, as you've seen with Infosys today and HCL Tech the other day. So you will get to buy some great franchises in this fall. It's not, I mean, you shouldn't be in a hurry, but to do that, you should have dry powder. And that's where asset allocation comes to the rescue. If you have been cutting down equity allocations through this rally over the last 2-3 years, you would have that ability to buy into an equity drawdown, particularly buying into great franchises. So I reckon from a very broad-based rally over the last 2-3 years, we will move into a situation where it will become a market for stock pickers from a bottom-up perspective, because even the good companies will be available at good valuations in the coming few months.
I'm wondering what your call is, Pramod. Are you still gung-ho on your consumption story, some of them like Trent, etc.? Are you feeling a little disappointed when it comes to banking? What are you making of IT? Can we get a little more specific on your take on, say, these three buckets that I've just mentioned?
Well, I think on consumption, clearly the consumption weakness is hurting everybody. It is a bottom-up play. At the end of the day, some of the stronger franchises will be able to weather the downturn better. And therefore, I think if you are positioned in businesses with strong balance sheets, some sense of comparative advantages, they'll be the first to recover. In fact, they'll come out stronger out of the downturn as they start taking market shares from the weaker franchises. And remember, in all this, the longer term macro remains intact for India. So at some stage, we will see the cycle turning positive, and that's where you want to be positioned with the better franchises, whether it's consumption, IT, or pharma. On IT, I reckon it's actually a little bit of a better place to be. In scenario one, where bond yields continue to rise in the West and the rupee continues to depreciate, you have a natural hedge in your portfolio, as most of IT's revenues are dollar denominated. On the other hand, if we see some cool off in terms of inflation, as we saw in the print from the US a couple of days ago, talks of rate cuts will come back again. And if rate cuts continue, discretionary spending will come back. You'll have protection on the upside. The fact that IT is corrected in the last couple of months, I'm not saying that on an absolute valuation perspective, it's very attractive. But given everything else that's happening in the domestic economy, IT might give you some cushion in your portfolio. As far as banks are concerned, particularly private sector banks, that we continue to maintain, that's perhaps the only place where you have valuation comfort across the market. I know it's not particularly great in terms of earnings, but some of these franchises have delivered in the long run. And there is downside protection in terms of valuations where they're trading at compared to their historical averages. So either you're positioned in places where there is earnings visibility, or you're positioned in places where valuation comfort is there. I think private sector financials are in the latter category.
What's the earnings visibility? It's my question, Pramod. I mean, and yes, you've said that the IT play is there, but we've been speaking to analysts this morning and some very strong views on the disappointment, not just with one set of quarterly numbers, but directionally. And let's keep external factors like where bond yields go or what Trump's policies will be to one side. Those are external factors. But just in terms of direction that these companies are taking, our pride, our IT majors, what would you make out on that front from what you're hearing from management? Let me come to you on that first.
Yeah, I mean, IT is a macro cycle play, right? So while we might think that they're doing some very bottom-up technology stuff, it is at the end of the day a play on discretionary spending of Western enterprises in terms of boosting their IT spends. A lot of the services are fairly commoditized. To that extent, it is dependent on the rate cycle in the West. Having said that, there are very strong positive factors for IT as a business model, right? This is a very asset-light sector, extremely cash generative, very predictable as well. Almost 80-90% of their business tends to be repeat business. So therefore, there is natural downside protection. Plus, there is plenty of scope for inorganic growth through acquisitions. Given you are throwing off so much cash, you can augment your organic growth with inorganic growth, and provided you're making those acquisitions at reasonable valuations. So IT provides a very long-term cushion. Having said that, I think the last 2 years, I think, in fact, post-COVID, there's been a structural re-rating in the IT sector. So from an absolute valuation perspective, I would still be circumspect. But given the domestic economy challenges, I would still be positioned in IT for the reasons that I stated earlier. There are structural changes in the sector given generative AI. Some of the effects are positive in the sense there'll be whole new streams of work that will come towards the IT services industry. But at the same time, the use of generative AI to deliver those services would also mean a deflationary effect on the top line, because you'll be able to deliver those services with fewer engineers compared to the past, and hence the billable hours or your top line will deflate to that extent. The net effect, I reckon, will still be positive. We are living in a world where the role of technology is only increasing. I don't think anybody contests that argument. To that extent, there'll always be a place for IT services to find its value. For all these reasons, I think it should be a core part of any portfolio, in my view.
Okay, now give me a sense. Two big events coming up in the next couple of weeks. One is, of course, the Trump takeover, the Trump inauguration, and the other one is the budget. Let's start with how you're looking at Trump 2.0 and its impact.
Yeah, I mean, like I said, given the rhetoric in the run-up to the election, the markets are clearly assuming significant action on the tariff front, which are going to be inflationary in nature, and therefore the bond markets have already reacted. I mean, they're up almost 100 basis points in terms of bond yields, the 10-year bond yields for the US, taking them back to their 2023 peak, actually. And this is when, at the beginning of 2024, all of us were thinking that we're at the beginning of a rate cut cycle. Nobody anticipated that. So that will be very closely watched in the first few days of the presidency. How much of that rhetoric actually translates that into action? What we saw in the previous tenure was, whilst the market greeted the Trump victory with pessimism. Remember 2016 towards the end, the markets fell on Trump's victory, but 2017 turned out to be a really good year. To that extent, I'm still hopeful that policy action could be very different from what's being talked about. And hence, you'd rather wait and watch than just jump into this scenario that you will have tariffs and inflation and bond yields continue to rise. Having said that, I think we're all been surprised by the strength of the American economy. Despite yields being where they are, you've seen the unemployment numbers, you've seen the GDP growth numbers. So therefore, I think that augurs well. A strong American economy augurs well for the rest of the world, for India as well. As far as the budget is concerned, I think we discussed the challenges that the government is going to face. There is clearly an impending need to boost consumption, leave some money in the hands of the consumer, but at the same time balance the situation with the fiscal consolidation plan.
So, okay, how in the distance will the Q3 poor show, and I'm saying poor show with some of the numbers coming in, we have to wait for all of the numbers to come in, so far Q3, so with that disclaimer, how much in the distance will it seem post-Feb 1st? My question, Pramod, is this going to be still the biggest thought weighing, say, on your mind when you're looking at your allocations? And how much importance are you giving to Q3 numbers specifically? Because all of these companies at the end of Q2 have said second half is going to be better. Q3 is showing no signs of it. So unless you have some miracle in the fourth quarter, seems like they're going to be missing some of those estimates.
Yeah, I think it's very early days as far as Q3 is concerned. I reckon it'll be better than Q2. Q2 was particularly bad. Like I said, the first half of the year, especially sectors which tend to report pretty late in the earnings season, which are more domestic economy, domestic cyclicals, were exposed to the public capex slowdown. And from what we can see, the government spending on capex has picked up through November and December. So I reckon at least those sectors should report better numbers, but nowhere close to where their valuations are in terms of expected returns or expected earnings. The early set of numbers, of course, IT, like I said, these are not disastrous numbers. But the market's been very, very brutal in terms of punishing near misses as well, especially with IT, given its external facing nature. You are exposed to the situation that I just described in terms of bond yields going up, where the expectations of rate cuts, which were built into IT earnings, rate cuts would trigger discretionary spending. If that's been readjusted, that seems to be what's playing on IT. So I wouldn't read too much into the earnings weakness so far and extrapolate it to across the market. I would reckon Q3 would be better than Q2, but nowhere close to what the market would like.
Q3 better than Q2, but should we really, be okay with the relativity? I think we'll have to wait and see. But thank you so much, Pramod Gubbi. Always a pleasure to speak with you.